So, did you know that when two people are applying to get pre approved for a mortgage, both people are using their debt and their income and their credit to see what amount they can get approved for, which is usually a higher amount when you include their income, unless they have a lot of debt. But the credit score aspect of that is that they don't average out the credit scores between the two applicants. It's actually the lowest score on the account is the determining score for the entire file. So if someone has a 700 score, another person has a 600 score, the 600 score is going to be the determining score for the entire account. As to why they don't, average the two scores together to give you like a 650, for example, I'm not exactly sure, but the lowest score on an account is going to be the determining score for an account. And did you know that you don't necessarily have to have just two applicants? You can have three, four, five. The more applicants you have, of course, the higher most likely that you can go and purchase price. But you got to also take into consideration their debts that they have and also the credit. Because again, the lowest credit score on the account is going to determine what the entire file is. So that's unfortunately what usually happens is that usually somebody that makes really good money, really good money for the file, they have bad credit because they don't pay their bills on time. Or the one individual that has excellent credit has no income. So it can be very, 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 very annoying. But that's why it's always best to work with a local professional in your area to determine, hey, this is what your score is, but let's see what we can do to increase it to where it needs to be. And that way, hey, not one person's bringing down the entire account.